Hey there, my name is Robert Reynolds, and in today's video, we're going to talk about something that a lot of people don't consider when they're evaluating a business: the return on invested capital, or ROIC. Many people look to net income or revenue for profitability metrics, but what I'm going to show you today is that the return on invested capital is a more important metric because not only does it tell us how profitable a business is, but it also gives us insight into the quality of management. Are management generating a strong return for its shareholders? Let's get straight into it. We're going to break this video down into three segments. Segment number one: how powerful is the return on invested capital when analyzing a business, and why every investor should consider the return on invested capital before they invest in a business. Secondly, how's the magic formula created? Return on invested capital has two different elements to it: the return component and the invested capital component. And if we can understand how that formula is created, we've got a better idea as to whether we can forecast into the future a strong return on invested capital or maybe a moderating return on invested capital, which will drastically impact results moving forward. And then finally, I'm going to show you guys a quick and dirty way in which we can analyze the return on invested capital relative to the historical performance of the business. And that'll give us insight into the management's quality. How good is this management at generating shareholder return? And secondly, against its industry and sector peers. How profitable is this business? We want to essentially invest in the most profitable businesses with strong, good quality management. And that's the power of return on invested capital. So let's get straight into it. We're going to start off with a quote from the great Charlie Munger. At the top of the page here, we've got, "Over the long term, it's hard for a stock to earn a much better return than the business that underlines its earnings. If a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result." Let's put that view to the test. What I've done here is I've taken the average return on invested capital from 5 different businesses in 5 different industries over the last 15 years, starting in October 2007. The reason why this is very interesting is if we look at October 8, 2007, that was the peak of the S&P 500 before a 56% decline. So if you were to buy right at the peak with these good, quality, solid businesses over the past 15 years, what would your expected return be if the quality of management was very strong, the return on invested capital was very strong? What would your results have looked like in that mixed bag of companies? Well, you would get a return on invested capital to the present price of Pool Corporation of 20.82%. It's important to note that that's total return. Some of these companies offer up a dividend. The Taro Company, 15.56%, Copart, 20.02%, Medifast, 24.54% compounded over 15 years, and Lennox International, 15.15%. Relative to the total return of the S&P 500 over the past 15 years to the present day, 7.95%. So return on invested capital is a measure of the quality of management and their ability to generate shareholder returns, as well as the profitability of the business. We want to invest in very profitable businesses, and we want to invest in really good capital allocators. Segment number 2. If we can understand the nuts and bolts of this calculation, it makes it a lot easier for us to determine the probability of how consistent those returns are long term. As Charlie Munger said, over 20 or 30 years, it doesn't really matter what you pay for the business today, with a key caveat: how consistent are those returns? Now, if you don't understand how the calculation is put together, it's very hard to understand what's actually driving those returns. Once we understand it, we can make some very considerable decisions based on the business that we're analyzing. So let's have a look here. We've got 2 different elements. First element, we've got return. Second element, or variable of this calculation, we've got invested capital. Let's start off with returns. I've seen 3 different ways in which people have considered returns in this calculation. First way, net income. Second way, EBIT, earnings before interest tax. And the third way, which is arguably the most popular, NOPAT, net operating profit adjusted for tax. Naturally, each of these are going to give you different results. There's slightly different calculations of returns. And me personally, I usually use net income, even though it's less used by most people. The reason why I use net income is simply because let's have a look at EBIT. EBIT is earnings before interest and tax. Let's say you have a business that's way over levered, a huge amount of debt. Well, if we're excluding the interest payment on that debt, it's not going to give us a clear idea as to what the real returns or the cash flows of those businesses are likely to be. And so when I'm looking at net income, it factors in interest. It also factors in tax. Tax is a real expense. And so net income is able to offset the leverage in a business. They're the three different ways. It'll give you a slight variation. No matter what way you calculate it, there will be a slight variation. It'll still likely to be positive, trending in the same direction, but it might be plus or minus a couple of percent. Invested capital is also very, very simple to understand. How does a business function? Where does the capital come from? It comes from equity and it comes from debt. And you need to factor both of those in. Now, every business has a completely different capital structure. Some businesses might be financed more through equity versus debt. It doesn't really matter. And you don't really need to worry too much about that, because when we're looking at balance sheets, they're usually structured in the same way. So a capital structure of a business might be very different and very specific to a company, but a balance sheet is always structured in the same way, so you don't need to worry. So what we have here is a balance sheet, and what we're looking for is debt and equity to understand the invested capital. All of this here will come at the bottom of the balance sheet. So we're going to start off here with debt. We want to factor in short-term debt, long-term debt. There's one thing that I forgot to factor in here, which is very important, and I'm glad I forgot to factor it in because some people miss this. Long-term debt is usually displayed in total liabilities. It's below current liabilities. What's the difference? Current liabilities are liabilities coming due inside the next 12 months. So if you have long-term debt, it's not coming due in the next 12 months. It goes down towards total liabilities, which also factors in current liabilities, but also longer maturing liabilities. However, let's say I took out a loan, and that loan is for 10 years. 9 years from now, it'll be in its last year before that loan matures. And so because it's maturing inside 12 months, what happens is that long-term debt, that current portion of the long-term debt that's coming due, has to be accounted for in current liabilities. So don't forget that long-term debt can be displayed, the current portion can be displayed in current liabilities if it's coming due soon. And as you can see, I forgot to mark that off. But that's something that catches a lot of people off guard, and they forget to factor in that there is a little bit more leverage or debt to the business. So we calculate the short-term debt plus the current portion of long-term debt coming due in the next 12 months in current liabilities, and long-term debt, total liabilities. Very simple stuff. After that, we have deferred taxes and other liabilities, which you'll find in longer-term liabilities, right down here. And then after that, we want preferred stock and common stock. At the end of the balance sheet, you'll see equity. Usually take total equity. What you do is you add all of these together. When you add all of these together, you divide it by your net income, your EBIT, or your NOPAT, whatever it is you're using, and you'll get a percent. Let's say your hurdle rate is 20%. That's ultimately what you got to be focusing on. So what's the information we can take away from this? Well, we'll be able to understand whether the business needs more debt or more capitalization relative to its income. There's a lot of business and business structures out there that are capital light. The investment that's required is a lot less. So what you end up happening is an invested capital that's fixed or somewhat fixed, and income growth that's variable. Long term, what that means is your invested capital might need to go like this in order to generate returns like this, meaning that you continue to maintain very strong return on invested capital. That comes down to the business structure and the specific industry that you're investing in. But this calculation can be very powerful, and it can be a massive driver of your decision making, certainly over the long term when you're looking at investing in a business. Let's move on over to our spreadsheet. I've pulled the data for the last 15 years on the balance sheet and the income statement from Ticker Terminal, which I'll show you guys in just a moment. Over the last 15 years to show you the differences between calculating return on invested capital using net income and using EBIT. So this data here, the last 15 years, what are we doing? Let me zoom in so you can all see this. What are we essentially doing for every single year? We're calculating the short-term borrowings plus the current portion of long-term debt, which is a short-term liability. It's coming due in the next 12 months, plus long-term debt, plus deferred tax liabilities and other liabilities, and your total equity. That is your invested capital, as you can see down here. That is your invested capital. That's the capital that the business has invested. Below there, we've got the return relative to net income. So we're essentially dragging net income, which we find on the income statement. This here is the income statement that I've also taken off for the last 15 years for Pool Corporation. And as you can see, there is your net income. You can also find in a lot of cases EBT, which would be earnings before tax, or EBIT or EBITDA on the income statement. In this circumstance, we're looking at net income. And the reason why I'm using net income and not EBIT is because the platform already calculates return on invested capital, which I'm going to show you guys a little bit later using EBIT. I wanted to show you that there is differences between both of these, but longer term, you'll see that it gives you an idea of the general direction of the trend for your return on invested capital. As you can see, both of them are consistently above about 15%. Anything above 15% is fantastic on average over a long period of time, and that's ultimately what you want to be aiming for. Now that's return on invested capital, but how do we know whether a business is actually generating a strong return for us? And there's a way in which we can do that. We can look at what's known as the weighted average cost of capital, the WACC formula. Now there's a separate video on the channel which breaks down the weighted average cost of capital. So a company essentially finances itself through two different ways, both equity and debt. Equity has a cost of capital too, it's volatility. So if a share price is essentially trading at 20 times earnings, and then you have high volatility and the share price drops down to 10 times earnings, if you need to issue equity, that volatility is a cost. That's the cost of capital. We can calculate the cost of equity or the cost of capital using equity using what's known as the capital asset pricing model. There's a separate video on the channel which breaks this down. It's very simple. The cost of equity as well as the cost of debt. In order for us to understand what the weighted average cost of capital is, we need to know what the total debt is plus the total equity, and then we need to calculate the weighted average cost of capital. What we want to see is that the return on invested capital minus the cost of capital is positive. If we see that the return on invested capital is at a higher rate than the cost of capital, the management are doing us a massive service by generating shareholder wealth. There's a lot of businesses out there where the cost of capital is a lot higher than the return on invested capital, and it works in reverse. That's shareholder destruction. So as you can see, the weighted average cost of capital as of today for Pool Corporation in this example is 8.37%. And as you can see here, it doesn't matter which way in which you're calculating the return on invested capital, whether it's with net income, 26.9%, or whether it's with EBIT, 32.5%, we still end up with a real return for shareholders. Management, in this circumstance, are generating strong shareholder returns for us. Real returns outside of the cost of capital. And those strong real returns are essentially what's going to be reflected in the equity performance. So as you can see, the average return on invested capital for Pool Corporation over a 15-year period has been 29.07%. Now that's using EBIT. It's a little bit less if you're using net income, but it's still very strong. If you look at the compounded growth rate factoring in a 44.59% decline off its most recent high, you still have a compounded growth rate of 20.82%. What's driving that return? A strong return on invested capital and a management team that's generating shareholder wealth for us, the shareholders. Segment number 3, how do we do a quick and dirty calculation? We're going to be using a fabulous resource for retail investors. It's Ticker Terminal. If you guys are interested in using this, there is a freemium version. You may not even have to pay for it. The link is in the description below if you'd like to check that out. Ticker Terminal has just about every single company that I've ever wanted in international markets, in every single market internationally, and they also have 15 years worth of data. They do an awful lot of these calculations so we don't have to, and they allow us to compare this data relative to its peers in different industries and sectors, which is fantastic. So we're going to be using a company called Arista Networks. ANET is the ticker for no other reason than it's a pretty cool company and I happen to like it. Arista Networks, key in the ticker, and we'll click on Arista Networks. As we scroll down here, we're going to go over to financials. As you can see here, comes up the income statement, comes up the balance sheet, comes up the cash flow statement, ratios and segments. We want to go to ratios. These are return ratios. At the top, you can see return on assets, return on capital, return on equity, return on common equity. And we can click on that and it'll give us a chart and it'll give us a view of how this looks over time. We can go show labels. Okay, outside of the first year, this company only IPO'd back in 2015, but outside of the first year or two, you can see that this is comfortably above 20%. That aside, what we want to understand is how it's calculated. So if we hover over that I for return on capital, this is actually on return on equity, we want it to be on return on capital. You can see that long term, this is above 20%. The return on equity is still very strong as well. If we hover over the I for return on capital, what we can see is it's the same calculation for invested capital. Total debt, total equity, deferred tax liability, deferred non-current tax liability. Same invested capital calculation, but the return is slightly different. It's not that it's slightly different, it's just a different way. We've got net income, we've got EBIT, we've got NOPAT. This platform uses EBIT. There's nothing wrong with that because it'll give us an idea of the general direction of the trend and how strong that invested capital actually is. So in this circumstance, it's above 20%, but how exactly do we measure this against our peers? Well, first of all, we need to understand who the peers are. And if you haven't had time in order to figure that out, don't worry, because Ticker Terminal have already done it for you. So if we go to valuations, we've got three headings here. We've got multiples, street targets, competitors. We click on competitors and you'll see that all of the competitors in the communication equipment segment, which is where Arista Networks operate, will come up. And as you can see at the top there, you've got Cisco Systems, Motorola. We're just going to take those top three. Cisco Systems, ironically, the founders of Arista Networks used to work for Cisco Systems. Big legal battle going on back in 2015, 2016. So they're very close competitors. We're going to take the top three. How do we measure long-term historically the return on invested capital? We just saw that a moment ago. Since its inception back in 2011, we've been above 20%. Very strong return on invested capital, good quality management. How do we measure it against its peers, however? Because as you can see, when we look at the competitors' multiples, it only comes up enterprise value to revenue, enterprise value to EBIT, price to earnings forward 12 months, market cap to free cash flow forward 12 months, and then you've got some other headings there, just general data. So what we want to do is go back over to financials. We want to click on, it's already still up. We want to have our return on invested capital, and you'll see a column here. If we click on that, and we key in CSCO, Cisco Systems, the chart will come up. And as well as that, we also want to do Motorola as well. MSI is the ticker. That'll give us the competitors to Arista Networks. But as you can see, it's a little bit messy because it's a chart. So we're going to change that to columns, bar chart. As you can see, if we hover over Arista Networks, you can see first and foremost, historically, since inception, very strong return on invested capital. What does that mean? It means the management team are generating strong returns for shareholders. If we look at their peers, however, is it the best opportunity in the market? Well, since 2015, what you'll see is actually Motorola have had better return on invested capital. It's been a more profitable business than Arista Networks. And as well as that, what's also very interesting is over the past 3 years, you've seen a massive jump higher in the profitability of Cisco Systems. So it might come down to the valuations of each business, but what it's telling us from right now is Arista Networks historically are generating strong shareholder value for us shareholders. And at the same time, if you're a shareholder, I'm not a shareholder. And at the same time, it's also telling us that over the past 7 years that it may not have been the best opportunity in terms of profitability, maybe Motorola was. And that's the benefit of looking at the return on invested capital. We can now go and look a little bit deeper into both Arista Networks and Motorola to better determine which one we want to essentially invest in. Remember, we want a good quality management team, and at the same time we want a very profitable business, and that's the benefit of using the return on invested capital. If you're interested to learn more about profitability metrics, check out our other videos on return on equity, Warren Buffett's favorite metric. Thank you very much for your support and have a great day.